Well, just like we like to do, man, we like to jump right into things, Chad. So thank you very much for joining us today at Ask an Angel. And to get started, we're going to jump right into your background. So maybe you can share a little bit about your past, kind of where you've been, where you're going, and one thing about you that no one would know.
Oh, that's a good one. So, okay, I guess I have a bit of interesting way into the technology ecosystem and venture capital angel investing space. I'm Canadian from Calgary. I left Canada about 12 years ago, moved overseas and got a law degree, and then basically looked for an emerging market that I could go to and basically learn venture at the ground up. And so I ended up in the Middle East in Dubai, where I spent 7 years, first as a lawyer. And then about 4 years ago, I kind of figured out that selling 6-minute time intervals wasn't a very good business model, and that I didn't actually want to, go in and operate a company. And so I left practicing law. I took kind of all my relationships on the company side and on the investor side and started angel investing and putting together syndicates. Because I was a lawyer, I kind of got access to two things. One, good early stage companies came to me and wanted support, advice, and the kind of angel investor community or family offices basically said, okay, I had good deal flow and I knew how to put together, the transactions and put together, SPVs and ways to invest. And so just started doing that and been doing that kind of the last 4 years, and invest only in early stage FinTech companies. And I guess something nobody really knows is that during COVID, I guess my wife and I have been in 4 different countries. So we've probably traveled more than most people. But I think a lot of the people that I do business with still think I'm sitting in Dubai. So they're going to find out today that I'm not actually there.
You should change the background then.
It's okay. It's okay. We can let the cat out of the bag, as they say.
Well, only because I have to ask, when you were going through these 4 countries, did every country have a different policy, or did you have to quarantine for 14 days in every different country?
So we started in Dubai, and then we left and we went to Europe in about August last year. So we spent a couple of months in Greece for the end of the summer. And then we went to Lebanon for Christmas to visit family. And then we came to Canada. And fortunately, when we came to Canada, it was nice because we came in on the pilot program. So we didn't do the 14-day quarantine. We had 3 days just with lots of tests. So I think over that Christmas period, we tested something like 9 times in 2 weeks. So we knew we were safe while everybody else was still running around wondering. So.
Wow, that's a lot of testing. I had no idea it was that strenuous.
We just had to test before and after every country, so not too bad.
Oh, okay. Well, that's awesome. Well, I want to touch back on kind of this pivotal moment where you went through, became a lawyer, then you started to work through this and you decided this isn't working for me. I need to get into more of this venture capital side. What was that changing moment? You mentioned you just didn't like the 6-minute calls or the 6-minute value, but you're still utilizing that skill that you built. So what kind of was that metamorphosis that kind of changed and you said, you know what, I really think this is a space I want to be in? Was it a startup that just blew your mind, or was it just the whole space that you'd been in for the last better part, I guess, of the last 10 years?
Well, so I've always kind of been in the venture space. And when I started looking at business models and things like that, I figured out that I didn't love the business of law. So that was the first step, right? And then I guess when you start looking at that, the business of, being a lawyer, my options were twofold. One, I can either try and change that, or I can leave the profession. And so what I first did was I took all my clients, quit working at a big firm, and set out on my own. And what I figured out very quickly there is that I was effectively picking my clients as if they were an investment, right? Because I was a solo lawyer. and I had limited amount of time. I didn't want to build a big platform. Very similar to what I do today as an angel investor is I had to pick the clients that I wanted to spend my time with. So I was effectively making that same investment. And then over time, I kind of got to the point where I was like, okay, I'm the only one that doesn't own shares in these same companies that I'm putting, doing these deals for, and I'm helping them and I'm, building value. And so I said initially, okay, I'm going to start writing, small checks. So it's like, what I first started doing was small checks, $5,000, $10,000 maximum. But then I would also do some sweat equity. So I'd give them, another $15,000 or $20,000 worth of services, and it went well. Then as that kind of grew and the number of companies grew, I had a decision to make. One was you can't really scale that. And so, I needed to make a decision if I wanted to do, a larger portfolio or if I wanted to stay concentrated. And then the other thing is that I was kind of spreading myself too thin. So I wasn't able to give the same best advice. So what I figured out was the companies that I like to invest in, they still can come to me for that, quick advice. I can still be very hands-on, but when we need, heavy lifting on a legal, on a investment round or, heavy lifting on contracts, it's still probably a better use of everybody's time and money to go and hire, a law firm to do it. And so that's effectively what I do now. I get access to really good early stage founders because I can actually add some value. And then I help them, in that seed to Series A to one, manage their legal spend, two, raise capital, make sure everything's kind of set up right. And I sit on the cap table and build some value and go from there. So that's kind of where we are today.
Awesome. No, that's a great story and a great way to jump into companies. So while you've been working in these companies, what kind of things do you see as being things that would stand out that you kind of can red flag for founders and say, hey, here's some real hot items that you should think about when you're building a company that maybe people just overlook because they're new?
I think, what I've figured out over time is, especially in early stage companies, it always comes down to the people, right? So, and whether that's employees, whether that's co-founders, whether that's, your early stage investors, whether that's the advisors you bring on board, making sure that all those kind of relationships are really sound and, really tight is super important. I can't, stress that enough, where you've seen co-founders having, an issue and breaking up and, causing the company to implode, where, they pick the wrong early, even pick the wrong angel investors or don't have that structured properly, which, then a VC comes in and says, okay, this is a mess and, you can't really fix it. Same thing with advisors, giving them too many shares, not doing vesting. So making sure that all those relationships are really tight at the beginning, I think is something that is super important to me and something that I try and help, a lot of early stage companies get right from the beginning. And I always told the companies when I was a lawyer, I said, okay, it pays to, take this seriously now, because if you come to me, a year down the line, I'm going to end up charging you 3 times as much, or it's going to be 3 times as painful to do that. And so that's kind of the biggest thing, is have those relationships tight at the beginning.
Agreed. And I'm sure that you've seen this many of times, and founders go through this quite often, where they have to try to restructure and fix a lot of the documentation that they didn't create. Is there, again, some recommendations on, here's 3 things from shareholders agreements, employee agreements, like, are the things that you just see that stand out? And I'm hitting your legal side because this is not a common understanding. I think that a lot of startups don't get, and I think utilizing your skill is pretty key to this.
I think the biggest thing is just to do it, right? A lot of founders try and push it down the road too far because they think it's going to be expensive. Now, there's so many, free or low cost places that you can get standard documents. And, it's always a good place to start. And what I always tell founders is it's better to have something than nothing, even if it's, with your co-founders, when you sit down, when you go, even the back of the napkin conversation where it's like, okay, here's, your step, here's your role, here's my role. This is, we're full-time or we're not. We agree that we're going to vest our shares, which is something that I like to use with everybody, whether that's, founders, advisors, early employees, so that if they do end up leaving, or you have a disagreement that an early person can't hold up the company, or at least if they vested, they lose voting rights if they're not part of the company. So the biggest advice is always just get it on paper. It doesn't have to be perfect. Contracts are always, a working document. They're a living document. They can be changed over time. There's standards in, every country of incorporation where there's, whether it's with certain associations doing it, some law firms offer it. There's a ton of free resources on the internet, and there's no reason not to have it done.
For the vesting part, and I do think this is important, especially if you're going in as a co-founder. Do you like one co-founders in a business or multiple co-founders? And then the follow-up to that is, when you vest shares, maybe you can explain more of what vesting shares means.
Yeah, so I'm of the opinion that I'm actually quite okay with solo co-founders. A lot of VCs and investors will say they don't love solo founders, but I've found a lot of the time that there's more of a risk at the beginning of founders that don't have a deep understanding of how to do business with each other, that there's actually more of a risk than just having a solo person. I think I've seen more times where co-founders end up having a disagreement at some point that causes problems over a solo person that kind of has too much control. Now, obviously, with a solo person, your biggest risk is making sure they know how to delegate and that they can, bring in the top tier talent. But I've never kind of had a situation where I've said, no, I won't invest in a solo founder. I actually, if I look at some of the companies that, I've invested in, or some that I've missed with solo founders, I've never seen it be a really, really big issue. So I'm quite comfortable either way, as long as, I really I probably dig into multiple co-founders more, and how do they know each other, and, are their skills complementary, and, really do due diligence around them more than if it's just a solo, because I know with a solo that we can build up that kind of the C-suite, the advisory board, the VP level, so that as long as I know that they can delegate and they have, a few core skills, then it's quite comfortable for me. And then to the second point on vesting, basically, for anybody that doesn't know what vesting is, it's the ability to either earn shares or claw back shares, depending on how you structure it, at certain either time intervals or at certain, performance intervals. And so there's a lot of standards that, you get in the industry where it's, okay, Chad, you're going to join XYZ company. You're going to get 1% of the shares, and they're going to vest over a 4-year period. So what that means, and usually it's after the first year, there's a 1-year period to make sure that everybody likes each other. And then from there, you get a certain amount of shares on, a monthly basis, or sometimes people do it where they get it on performance. So if you look at, even up to public companies like, Tesla, Elon gets basically shares every time he hits certain valuations and certain, targets, right? And so there's a lot of different incentives you can do with shares. But what I never, like to do is to give something away that isn't kind of earned. And it's I think in how you incentivize your company is probably the most important thing to, one, hiring, getting the right people, and two, the long-term success, right? It's another one of those things, like I said, the relationships are so important that can, make or break a company.
I love it. So now and we're going to talk more of this because I think this is really valuable. And I think there's a lot of people that overlook this until it hits them in the face. And then they decide, why do I got to spend 20, 30 grand to fix all this? And it really does come quickly. So now you kind of have this vesting period. This is an option. What if I'm a founder and I work on this product and idea with a co-founder and we did this all together? Do you recommend going in 50-50 into this business? Or do you recommend that one has 49% and the other one has 51? What is the best way to manage this? Because this is quite common and I'm curious as to what you recommend.
So I usually, there's no right or wrong answer to this. I think there's a lot of factors that play into it. Usually what I do when we sit down is you kind of sit down and look at who's bringing what to the table, right? So a good way to look at it is, okay, first things first, who's, coming in and doing the, ideation, whose idea is it? Has some value, that has some intellectual property. The second thing I always look at is how much time, how much sweat are you going to go and put into the company? And that's usually the first thing. Now, a lot of the time I always say it's better to start off on like a partnership foot. And so that usually I'd say is where you kind of end up at 50-50. Now, if I'm going to come in as, one founder and I've got some money to put behind the company and the other founder doesn't, I would almost treat that as if it was, an initial investment into the company. So that would be the first kind of capital that came in. And that's where, that would skew the ownership percentage. So anytime someone comes and puts, capital in, I consider it a separate investment event. And that usually kind of gets everybody sorted out. And that's also where vesting comes in and is important, because as founders, we should be investing as well. So if we get 6 months down the track and, all of a sudden I choose that I'm not going to work full time, well, there's I don't have all my shares yet. And so we can sit down and figure out a new kind of conversation around how that works. But I think when I speak to most founders, and I can't ever say I've been in this conversation, I've never had to make this decision for myself. What I've always seen is founders that start on an equal level will always go to bat for each other, as far as the company comes. I've seen where founders have, maybe they come in at a different time or they don't start it so one founder starts it and then another founder comes in later. That, is always going to end up very skewed and, doesn't have a true founder relationship. But I've always found the best founders are the ones that own it equally. And then if one of them puts some capital in, then they up, then it goes up, because at the end of the day, they're partners, right? And so if one partner has slightly more shares, then it's not a true partnership. And I find the best founder relationships are, partnership based.
Now that's super valuable. And now when you put together the shareholders agreement and you're balancing between the two, because as you mentioned earlier, there are founders that do break up and they do decide that they're not going to get along. And to protect this, is there, you mentioned different vested period, but when you're two founders owning 50-50, what does that look like? Do you put in shotgun clauses? Do you put in opportunities that will ensure that the ownership of the other company can take over or make someone a silent partner? What kind of options are there for founders?
Yeah, so I think a lot of it depends on timing, but I think there's two things. Obviously, you have you want founders to vest their shares as well over a certain period of time, and a lot of founders these days are actually going longer vesting periods, saying I want to show that I'm committed to this company for 5 or 6 years rather than the 3 or 4 that's standard. So I'm actually seeing that a fair amount where the founding team has longer vesting, but then they're doing shorter vesting for employees. So you're getting your shares every year rather than a 4-year period, right? With how the employment market's going. So having the ability to automatically claw back those shares is super important. the other thing that, I do a lot of the time with founder vesting is that if they do leave before they're vested, they lose the voting rights. And so what that effectively does is they get the economic value from the time that they put into the company, but they don't have the ability to hold up any of the decisions that need to be made. So they lose, any rights to a board seat. They lose any rights to, shareholder voting, with the exception of, certain things that can, negatively affect the value of their shares, right? So you can't go and, do a share split that makes their shares worth, 10% of what they were, just to kind of get rid of them. Things like that is the best way to do it. But they've added value regardless for a certain amount of time. And so they should have the ability to do that. And then the only other thing you can do is have the right to purchase it, right? Good leaver, bad leaver clauses, depending on how they exited. And that would then determine the value that they would receive for those shares.
No, that's great. And when you do set up these vesting periods, is it how is that structured to ensure that, there's two co-founders, they've got 5 to 6 years that they're going to earn out? Is this earning out on new shares based on hitting targets, or is this vesting just in general that the corporation owns, let's just say 100% at this point, the founders only own 20%, and you're letting them vest and grow into owning 50%, going to take them 6 years to do this, but that pool is being locked in just like an ESOP plan? Is that kind of the idea?
Yeah, so there's multiple different ways to structure it, and I guess it depends on the country that you're incorporated in. And I've done these around the world. So in some jurisdictions, they don't understand kind of the treasury shares where it can be issued over time. But the standard is that new shares are they sit as part of a founder pool, or similar to the ESOP, where they're locked in and they're issued at various intervals and set pricing. And those are given out over time. And if the other way to do it is just a reverse vesting, where the founders have 100% of those shares, but if they are to leave at a specific within their vesting period, that they agree to sell back the shares at that specific point in time. One is kind of obviously more favorable to the founders, and one is more favorable to the company and the other stakeholders. And so it kind of depends on how they set it up at the beginning. But I think either works at the end of the day. If a founder is leaving, they're gonna, there's ways that they can be clawed back, or they just are not given those shares over time. So it's effective in both ways.
And with these shares that do come back in the business, or the business owns, how much of this can be affected by a VC coming in later on and making investments to change up the way the terms are structured? Does that affect those shares that are in a treasury, or that they are being set aside for the founder's shares? Or take it even further and say that they're part of the board and they decide to out that CEO later on. And this comes up all the time. It's this fear of founders that they're going to raise funds and be outed. And we'll talk to that in a second. But in this process, does that affect any of that control?
Well, I mean, with all of these relationships, you look at it like a long-term 10-year relationship minimum, right? And then so you've got to do a lot of stuff up front. So I mean, when you're an investor, they're going to obviously see how that's structured and come in, and it shouldn't, a lot of investors will make founders, when they come in, revest their shares, right? So you see it, seed people are making them do, 3-4 years. And then I'll see at Series A where they come in and say, okay, you take our money and you've got to revest from Series A. And then usually from there that you don't see it kind of much after that. So yes, they can come in and, dictate those terms. Most of the time you don't see anything until something starts going wrong. But the most common one is to have the shares revested at various kind of points in time. And usually that's kind of up to Series A. I haven't seen it in any of the later stage stuff that I've, invested in or worked on. lately, but most of the time up to Series A, you're seeing that vesting. And on the second point, the biggest thing is you're getting into a relationship with the investor for let's call it 7 to 12 years, right? And you have to make sure you know who you're doing business with, and due diligence works both sides, right? All investors are going to come in and do due diligence on the founders, and the founders should do due diligence on their investors and know who they're working with. And just knowing the firm isn't, enough anymore. Know the partner, know who they've worked with, their style. We as investors do that on the founders. We do background checks, and so it should go both ways.
I wholeheartedly agree with that. I was on a podcast a few weeks ago, and it was around an investment that you made that you weren't happy about. And I'm sure they had different terms for it, but that's how I'm staging it. And one of them was my feedback was that make sure that if you're going in on an investment, investigate the investment, the people that you're investing with, because sometimes, they might not be on the right board as well, and they might not be on the right line that you're going at. So these things can be cause and effect later on.
No, absolutely. I think it's, like I said, the most important thing in all of this is the relationship. So it's, you all have to work together, and it takes, everybody kind of moving in the same direction. As soon as someone's not moving in the same direction, there's an issue. And so hopefully, everybody's kind of, professional enough to figure that out. But more often than not, it's not the market that kills these companies. It's the company kills itself. And so that's my biggest advice to all the founders. It's, you've got to do homework on everybody that you're getting into kind of conversations with. And it always isn't going to go right. There's going to be times where things go wrong, or people, have a change of heart, or you missed something, or, whatever it may be. And so then it's, just being kind of clear, open, and honest about it. And mistakes happen. And it's just, as long as if you have those strong relationships, when something does go wrong, you find out very quickly, who's there, and they're going to find a way to help you get out of it. So. Agreed.
Now, if you take, I guess, a little bit of a step back, and we talk a little bit more about what we chatted to on the ESOP side, when is a good time to build this in, and when should you allocate it? And should it be, when you do allocate the ESOP side, should that be post your first money in, second money? And should it be ownership shares that are being reduced versus or founder shares versus the rest of the investors? How do you kind of stage that, and what's the best way to allocate that so that you get the best outcome?
So the best time to do it is as early as possible. And there's two reasons for that. One is there's, no restructuring that needs to be done. It's clean and, easy at the beginning. But what it also does is it shows your really early investors as a founder that what's expected of you, right? And I think important thing for everybody to kind of see is, understand is what a venture type investor, what their business model is, what angel investors' business models are, what, different type of capital looks for. But whenever kind of that's why a lot of the time prefer seed over kind of pre-seed, because I know I get to see a little bit more, these subtle things that, show how much a founder is thinking, how much, they know about running a business. Is this, something that they have thought about? And if I go in earlier, at least in my experience, I end up doing a lot more of that heavy lifting and I don't get to diligence the founders the same. But I love when a founder comes to me and says, hey, Chad, I know, this is the ESOP, it's already done. This is what we're going to do. And this is how we're thinking about it over a longer term period, right? Like I've seen several really good companies that had built 15% into their ESOP, and it was never diluted, right? It was always 15, regardless of, the company was worth $1 billion. And that's quite rare. But if you look at, and that company is in the Middle East, it's called Kareem, and they were bought by Uber for $3 billion. And the people that have come out and started companies out of being able to do that, it's had a massive ecosystem effect. But they only got that right. And they were only able to do that because they did it before they brought on a lot of capital. And so ESOP generally in the beginning always comes from founder shares, right? Your first equity investors will always make sure that that's done as part of, the first shares coming in. You can grow it over time. And, we've done that a lot kind of, post Series A, especially if the founders take an early dilution hit for some reason. So if they take, a big hit in Val at one of the fundraising events, it's one tool that we've used to kind of re-incentivize them at a little bit later stage, give them some more shares or let them, do these things. And but always founder shares at the beginning. And then there's top ups that, have been agreed on that are kind of pro rata later stage for certain reasons or certain hires, etc.
Brilliant. Okay, so now you've got everything nicely structured. You've got ESOP, you've got founder shares. What do you look for when it comes to putting a board together? When do you recommend a board, or advisors or observers? Where do you see that tying in? And with those, can you give us an idea of what that structure looks like? Why do I have to have a board? When should I have a board? And what should I pay them? Should I give them shares? What do you recommend again on this side? And not just board, but advisors, observers, all of those people that are helping you build this company.
So I guess the distinction to make is the two differences between the two types of boards, right? So board of directors is the people that actually make the decisions of the company. And usually we're seeing that at the first equity financing. And what that usually is the first VC that comes in generally wants to take a board seat to watch over their money. And so usually what that is, if that's at seed stage, you'll see it, let's call it 2 founders and, an investor. The advisory board, I love a really good early advisory board, and I like the advisory board to rotate over time and be the advisors that you require at certain stages, right? Because there's a very big difference in your advisory board at, day one versus when you're going through the IPO process. And so what I like to do is those advisors, they have no decision making, but they're generally very influential and very helpful. And so, someone who's been through an IPO process, maybe a better time for them to come is after, when you're going for that versus on day one. And so I like the advisory board to be as fluid as possible. And, you can switch people in and out. And that should always come day one. Founders, whether they're solo or not, need people to support them and to help them. And so advisory board adds a lot of value from day one. Board of directors is kind of when you take money from someone else, you have to be accountable for that money. And so as soon as you take outside capital, usually is when you end up with a board. I don't like really big, heavy boards at the beginning because I think it takes the founders away from executing at speed. And at the end of the day, as early stage investors, we're believing in their vision and we have to let them get to the stage where they're a company. And then, every founder at Series A, they say their role switches from, it switches to board meetings, fundraising, and I guess still steering the bigger vision, but they become less operational. So there is a time when that happens. In terms of compensation, I think everybody wants to give away shares to these places. Your equity at the day one is the most expensive commodity that you have. And, so founders need to understand that and use that, appropriately. And I always look down the road, and I've seen sometimes where, I get into a company early and an advisor will have, 5%. And I'm like, okay, this is crazy. Like, what did this person do? But it's simply because they didn't understand it. And, they did what they had to do at that time. So I think small amount of equity for advisors is good. I think, again, it should be vested to make sure they actually, sign up to come to their meetings and do what they said they were going to do, actually add value. And then I also like to have, in certain situations, a call option to buy it at a certain valuation, right? So if, or at least a portion of it, so that you're again considering that as part of your ESOP. So a good example would be, okay, Chad's going to come and, advise this company for the first year. And for that, he wants, 0.5% of the company at the beginning. But if the company raises at, $100 million valuation, Chad agrees to sell 25% of that back to the company at that time, at that val. So what that does is it gives for me, I've got the value as an advisor. I came in, I added value, I created equity value, shareholder value. For the company, they have the flexibility to, recycle my equity and give it to that new advisor. They're not forcing me to sell it all, so I still get to see it through to the end, but they're, have a bit of flexibility. So if you can pay cash, because again, that early stage equity is the most expensive you're going to give away, but also, over diluting yourselves, to give away that or to be able to pay for that advisor may not make sense. Later down the road, when you take on board of directors, I generally like the board, depending on, to have less shares. And that's, you're going to have your investor representatives. And so they already are looking out for their selves. If you have an independent board member, they should have no shares to make them actually truly independent. And then I'm not seeing, till later stage, board fees being paid, but whenever you're kind of giving out equity, you got to be smart with it, right? It's the best incentive for employees, advisors, etc. But it's also the most expensive thing you can give away. But I always tell founders, don't be too precious with it, because having less of something really huge is better than having owning 100% of nothing. But if you make those mistakes early, then it's hard to claw back over time, and you have less flexibility. So it's more about being flexible in the structure rather than just hoarding 100% of the shares.
I love it. And there was a good nugget there that all great nuggets that you just shared, but the one part that I liked was being able to having that advisor sell a percentage of their I guess will be classified as ESOP, but the advisory role shares that goes into there. So it does force a sell, so that actually puts the value back into the company and allows for them to not eat up their equity when they are going on to that larger raise. Even though it's a small portion, I still think that that's a great nugget to add into the documentation.
Yeah. And I think a lot of founders, the secondary market is one of the most useful tools that they can use, right? Because like I said, there's certain people are helpful to the business at certain pieces of the life cycle, right? So your angel investors, angel investors can come across every stage. I mean, we're seeing in angel investing, you're seeing celebrities go in at pre-IPO. That's still angel investing. You're seeing people go day one back of a napkin in a coffee shop, being the first investor. I mean, that goes across the entire sphere. But I think what founders really need to understand is the secondary market is their absolute best friend, right? And what I mean by that is different people are going to be helpful to the business at different stages. And at certain points, it's better. You only have 100% of the shares. And so at certain points, it's actually better to, get rid of certain people, have them have a liquidity event, say, thank you very much. You got us from, 0 to 1. We now need our shares to go from 1 to 2. And using that secondary market is super important. And it's great for everybody, right? It's great for your advisors because one, they get to take some money off the table. The company gets to recycle those shares and reuse them for new advisors, etc. It's great for employees, as the value of the company grows. It's great to get rid of, early investors, or maybe you have, a busy cap table and want to clean it up. Also, existing investors may look at it and say, okay, I need, more of this company to return my fund. And so they may want to buy up shares. And so I think founders, if they really look at the secondary market, is something that a lot more could do a lot better job of using to, better benefit both the company and the stakeholders at the various different points in time.
I love it. And that's a really great point. And you see that a lot happening in these companies that are, call them unicorns or rocket ships, that a lot of that secondary market is really jumping in, and second and third markets. There's probably 10 markets jumping in. Everybody's trying to pull a piece of that company before it hits that stage. So where then it becomes a billion-dollar company versus 400 million and whatnot. So there is a lot of change there, and they are hunting down the people that originally were in there, trying to figure out how they can access and buy from those early stage investors or employees that are no longer in the company. So there is a really huge value there that's certainly being picked at in the market.
Yeah, I mean, it's something super interesting. I in emerging markets, I still use it as a business model, right? Because the exits are, IPO market isn't there, and the exits aren't there. So, if I go into a company at pre-seed or really early, I'm comfortable selling at least some of the shares at, Series A, Series B, because then I have realized some gains, right? I've realized taking a profit, and then I, get to sleep better at night. And I do this as a, full-time business. So I always have to be, having liquidity. And then you've seen some, like you said, there's, some of the pre-IPO unicorns. There's some crazy stuff that I see in this market. And some of them are even saying, okay, I'm going to sell you my shares, but we're going to put it into an SPV and I'm going to keep the carry, right? So you'll see them taking the 20% performance fee just to sell their shares into that side. But, I think if you look at some early stage investors that have done it well, like, Chris Sacca made himself a billionaire off of, one of the best kind of early stage angels, VCs. He made himself a billionaire off of doing secondaries, right? Because he went, in all his winners and set up SPVs and he knew everybody in the companies and, had the ability to go raise the capital. And I think it's the secondary market. If you're smart, it's the best place, one of the best places to be. And as an angel investor, it's a great spot to operate as well, because if you don't have the restrictions of a fund. And so if you see something that you like, you just go and, you go and do it. The hard thing at those kind of later stage ones, I think we're going to see some interesting stuff in the market is, how they're priced. Is it, a discount to their their last valuation? Is it a premium? How do you do any of that? How do you structure it? I think that's the hardest, part that people get. But I think until there's, some price discovery in the secondary market, then it's still going to be a very lucrative business.
For sure. Well, that was amazing, super informative. I probably could ask another 100 questions, but we're going to have to kind of move ourselves on a little bit here. So thank you for all of that. The next question I'm going to throw at you is just a quick story that might come to mind as you've been investing over the last few years. Have you come across any real exciting, heartfelt kind of moment where you thought this company isn't going to be able to pull this off, and they just somehow made it happen and they've taken off, or they're doing well, or maybe they didn't do so well, but you thought they were going to? Just one of those real, what it takes to be an entrepreneur, and just kind of blows your mind and you're like, wow, I got to share this story.
I think every single company has, they're all roller coasters all the time. There's no straight line to the top. Even, you see some of the big ones, and it's not a, easy road. I think that's the one thing all entrepreneurs, at least that have done well, or that the one trait that they all have is they all believe, one in themselves to a level that is extremely high. They're super self-confident that they have the ability to execute. But it's never a straight line. And the way that I look at it is I end up being that phone call, usually when things are kind of going bad as well, right? Because it's okay, let's call Chad before we call the lawyers. So, I've seen a lot of times around fundraising rounds where it's, they may not be having any traction, and it's, one conversation changes everything. And it's all about putting the right people around you. So I have one of my companies, I'm up, 85 or 90 times on this company. It was one of the first ones that I did, but their Series B was taking longer, just to put together, COVID, whatever. They're raising $50+ million. And, there was times where they were like, okay, and they couldn't go to a normal bank to get that credit. So what did they do? This is a credit to the founder that, okay, he put the right people around. One of the founders, wired $6 million to get them bridged into the next thing. But there was some, sweating going on behind the scenes saying, okay, what if we can't, make it to this round? And this is a company that's very successful, right? So what that shows is that even in success, there's moments where, you just have to find a way. And other companies at the early stage where, it only takes one person to change things, good or bad. I've been in some rounds where we're like, okay, I don't know if this deal's going to just 100% fall through and this isn't going to be put together. And then one investor falls, and then it's just, the momentum builds, and, it ends up being oversubscribed in the next 3 days. Like, it's funny how human nature works. And I think all of the founders that I've, worked with always, no matter they were good or bad, it doesn't matter. I mean, all the ones we choose to work with, I think we think are good. But life happens, and it just really is about how they manage that situation.
I like it. Nope, that's a great story. Okay, so rapid fire questions.
Let's do it.
All right. What's your favorite part of investing?
I love, well, obviously working with the founders, right? They're the most brilliant people in the world. They're taking risks that people aren't willing to take. They're trying to build things bigger than anybody else is trying to build. And they also are with some of the hardest working, most genuine people that you get to deal with. And so for me, that's 100% my favorite thing, and the sole reason that I do this. The rewards, it's a high risk, high reward business. And so, like, okay, if things go really well, we're going to all make a bunch of money, but there's a lot of times where it just goes to zero. And so I always say you don't ever really do venture or building these things for the money. You're doing it for like the bigger purpose of, building something interesting or being a part of something a little bit bigger. So I love the founders first and foremost. The thing that, gets me super excited is actually getting into a deal when they're fundraising, when I'm doing fundraising with the syndicate, right? When I've, diligenced the company and said, okay, I want to go do this, and, go to put it together. I mean, I love the adrenaline rush that comes with that side. And that's the best part.
Okay. How many companies do you invest in per year?
I have 17 portfolio companies. Most of those, I'd say, so in the first 2 years of doing things, I was, a bit more concentrated, a bit more hands-on. So I think I did, 5 or 6. And then the last, I think I've done 7 this year so far. So the idea is that I will do 12 to 20 companies a year, 30 companies in a 2-year period to try and build that portfolio.
Awesome. Any specific verticals?
All FinTech or FinTech adjacent. So I have quite a wide remit there, but most of the stuff that I've done is in kind of 3 areas. One is kind of the open banking API infrastructure play. The second one is capital markets and how they're being, affected. So, and that includes, blockchain, digital assets, traditional trading infrastructure, wide remit there. Then I've done, I guess, alternative lending. I like that space. So buy now, pay later. I've done an education platform in Indonesia, doing a couple trade finance, SME plays. And then the other one, the last kind of, I guess there's a fourth vertical that I love is kind of how the next generation are getting involved in, financial advice. So I've done a company in the Middle East called Baraka, which is going to be, Robinhood of the built from there, but for the world. And I've done a couple other, social platforms that do, embedded finance, right? So now you can pay through pay on Instagram or, transact through these different platforms. And this one that I did is, based in LA, and it's for mentors. So, you could jump on and mentor startups and they can pay you, through the platform, et cetera. And so it's not a pure fintech, but they figure out how people get paid, how people have new credit scores and things like that. And I've been quite successful in the embedded space, companies that don't look like fintech, but use that vertical. And so that's where I'm spending all of my time, very sector focused, but, investing across the world.
Awesome. Do you lead rounds?
I do not lead rounds. I love the founders too much for that. And I'm super founder focused. I always, end up being one of their closest advisors. And so I almost feel like it's a conflict of interest if I lead rounds. The second thing is I, operate a syndicate. And so we don't know how much we're going to invest in each deal until we go and do it. And so my sweet spot is being super founder friendly, working really closely with strong VCs that do lead rounds. And obviously I can jump in and help, but what ends up happening in most of the deals is the founders are calling me saying, what does this term actually mean? And so I end up being there. So I'm always founder focused, don't lead rounds, can co-lead if, there needs to be some reason to do it. But using the syndicate model, we tend to not be in a position to do that.
Okay. Do you take board seats, and do you have preferred terms that you like? If it's pref shares, safes, all of that?
I don't take a board seat unless I'm asked to. Obviously, if a founder asks me to do that, I will look at doing it. I tend to be more the advisory board, right? I'm usually the founders, one of their closest advisors, and it's usually better for me and for the founder, for me not to be on the board, because obviously when you sit on the board, you have a fiduciary obligation to the shareholders as a whole. And so I can't always back the founders if they are going against kind of that obligation. And I am a, founder first. And so I tend to be a better advisory board member, or that, 3M phone call rather than a board of directors. And then in terms of, terms that I like to see, I think, the space has gotten where it's so standardized now that the standard terms are there and set, and there's not a really strong reason to go outside of them unless there's something in diligence that came up that, needs to change it. And so I also think, when you're early stage investing, so I like the safe versus convertible notes. I like, especially at seed stage, and, this changes later on, but at seed stage, I think there's, no reason for, a debt instrument, in the sense that you weren't approaching the company to provide them a loan. You were approaching them to get equity at a certain stage. And so I'll use a safe. I use a side letter on a safe too. I'm not going to lie. Like, I like my information rights. The safes do miss a few of those things. I like information rights. I like, pro rata rights, being able to continue to invest at the later stages. I mean, I like, making sure that those things are there. And so I'll use a safe and a side letter at those early stages. And then just usually fairly standard terms. I find anytime you're changing things up from what's going on into the industry is usually a red flag either way. Like, either if the terms are too onerous, you're kind of wondering what the VC or the investor's trying to, do. Or if they're too light, it's like, okay, what's going on here? But those kind of the sways with how the market's going, right? There's so much money in the market right now. We're seeing, safes with no cap, no discount, and just, most favored nation to get into companies. And I would have 12 months ago, I would have never invested in a no cap safe. But now you're kind of, if you want into some of these hot deals and some of these companies, you kind of just go with the flow. But obviously the standard documents are there for a reason. Most countries have adopted a standard set, whether it's, in the VC associations, angel groups have their standard stuff. And so even though I'm a lawyer, I tend to stick to the standard stuff unless I find something, in diligence that needs to have additional, safeties or, protection put in. So
I love it. Okay. We're going to shift quickly to some personal questions. We're almost there. We're right at the end. All right. So first question, what do you think is the secret sauce to investing?
So obviously just picking the people. I think if you're doing angel investing, it all comes down to the people, and it's not just the founders, it's everybody that they have around them. Are they able to recruit both advisors, team, and investors? I think the other thing when you're investing, and this is something I've learned a lot over the last 2 years, is kind of the cadence and the amount that you learn through the investment process. I see a lot of new investors come in and they want to, I just, I had some money left over. I didn't go on vacation this year. I want to angel invest. And they come and just put it all down on the table up front. I've seen a really, interesting learning for me was, spreading things out over time. I think for early, new investors, saying no more often is, there's very few companies that, I've said no to that down the road I've wanted to invest in and haven't been able to get into, right? Most of the time I'm still able to find a way in. If I passed on something for some reason and said no, I usually find a way in. So saying no more often is something, but doing some due diligence, you're backing the people, trust your gut on, a lot of the stuff. If something doesn't seem right, ask a lot of questions. And there's no, whenever you're investing, there's no bad questions, right? So
okay,
those are kind of my
good
secrets, not really secrets, but that's kind of what I use.
Yeah, no, that works. Okay, next, what is your favorite sports team?
Calgary Flames.
Nice. All
yeah,
right.
even I'm not going to say anything. We can't speak hockey today. We're all in, and I do live in Toronto at the moment, and so we're in a state of mourning here today.
Yeah, well, I don't know. Montreal seems like they got somehow found a leg to make it work. So I'm not sure what Toronto's problem is, but we'll jump into the next question.
Yeah.
So, what is your favorite movie, and what character would you play in the movie?
Oh gosh, my favorite movie. I watch a lot. I've kind of watched a lot of movies over a lot of time. I don't really have a favorite movie. There's been a lot, and we've kind of, I guess, everybody through COVID has done the whole Netflix thing, and my wife and I are no different. We don't really watch TV, but we do enjoy a good movie. So I don't know. I can't pick a favorite, and I don't know who I would play if I had to act. So.
All right. You'll be the first one that's never picked a movie. You don't have one? Star Wars, something?
No Star Wars. Well, I don't know. There's too many. There's too many. I watch a new one too often, and I kind of I don't look back. Just keep going on the new one. So probably the last one that I watched, and I can't even remember what that was.
Okay. Awesome. All right. Last question. What's your superpower?
Gosh, that's a good question. I think for me, I wish it was something more interesting, but I just have the ability to kind of do what it takes for the people that I'm, doing business with and working with, right? Like when founders, for me, it's super important, and I'm taking this in the investing context, I guess. it's super important that when I pick a company to go with, that I'm with them the whole time, right? I'm never gonna kind of, abandon that. And so I guess I have a stomach for the ups and the downs. And I can, some say it's a bad thing, but when things are going bad, it's okay. Try and figure a way out of it. And there for the people that I work with. Because I think, the most important thing that we have are those kind of relationships. And so I guess that's a decent superpower. I wish it was like seeing into the future. And so I wish I had that so that we could pick those companies doing what's next now or start them now. Or, I wish I had, hindsight to put more money into Bitcoin or things like that when 5-6 years ago when we were all looking at it. But I wish that was the superpower. But I guess as investors, we're all trying to have that as our superpower. So if it's any of my LPs out there, listen to this. My superpower is seeing into the future, and we're investing in that today. So
I love it. Well, I think it sounds like just from everything we've talked about, I think one of your other superpowers might be relationships. Sounds like you value those, and I think that makes a big difference. So that's a pretty big superpower too.
I appreciate that.
Well, I want to say, Chad, thank you very much for all your time today. Fantastic. I always say I don't take notes, but it seems to be the moniker of it. I'm a writer. I got to take this stuff down, but I think that fantastic. You shared a lot of great insights and information, and I'm sure the community is going to learn from that. And again, thank you. And the way we like to kind of end our shows is that we like to give you the last word. So any comment you want to say to the investors or to the startups, feel free to take over. But again, thanks for your time today.
No, I appreciate you having me. So for any startups, you can find me on LinkedIn or on my website. It's foxventures.io. If you're angel investor, family office, institutional LP, you can invest with me. I have a syndicate on Angel List, or we do, have some small committed capital vehicles that we do. So feel free to reach out, and let's build some great fintechs all together.
I love it. Perfect. Again, Chad, thank you very much for that.
Appreciate it.
Okay, that was fantastic. So many great things there. I think that startups are really going to like and understand more about how to set your structure up of your company, all these things that really do make a big difference earlier on, from vesting, ESOP, boards, how to pay them, all that great stuff. Check it out. Like us, share, find us on all the platforms. But thank you very much for your time, everybody.